So this semester, these are the key themes that are addressed in the readings that you would have had for today that are in the book that I just want to talk about. Theme number one, that McKinsey calls them the four cornerstones of value creation, is that you don't create value by growing your sales and growing your earnings, right? And what's going to matter more to the professionals is what return on invested capital do you earn, not what profit do you earn, because they're going to care about how much money you spent to generate those sales and profits. And two, how much risk did you take? So we're going to risk adjust everything with a cost of capital. So what matters more is not the profits. What matters more is the return on the investment, called ROIC, against the expected return, which is the cost of capital for the risk that you took. Right? That's the way that we are going to learn to view industries and companies. It's really NPV. Right? Think about it this way, that the real value is not the profits, the real value is the NPV. So the value of the company is like an NPV. And so the question becomes, okay, how does a company create value? It's got to have a positive NPV. ROIC is kind of like IRR. Cost of capital is the R. The IRR has got to be greater than the R over the long run. It applies with companies just like it did in your Finance 101 class. We're going to prove that throughout the semester, and that's a very core theme. Core theme number two, you do not create value through financial reengineering. This is Modigliani Miller. And this is something that a lot of people struggle with. I'm teaching an online MBA class right now, and one of the students, who's an accountant by training, he's now in the MBA program, is really struggling with this. Because we're talking about value creation, and I'm like, how does this company create value? And he's like, well, they can just do an inversion and go to Ireland to save income taxes. Or they can, do this other transaction which will result in less taxes being paid. And I'm like, no, that's not really value creation as we're trying to define it. And a lot of people struggle with this because what you'll do is you mix the pieces of the business together. What we want to do is we want to separate a business into two pieces. Piece number one, a business generates cash profit from operations, right? Second, how do you most efficiently distribute that cash profit? Most people mix the two together, right? But the point is, whether I pay a dividend, pay a shareholder through a stock buyback, or pay out debt, or pay a tax, the amount of cash profit that I made didn't change. So that's the point. There's a certain amount of cash the company generates, and then what I want you to think about separately is how is the most efficient way to distribute the cash. But the distribution of the cash does not change how much cash is available to be distributed. What it really creates is a zero-sum game. So I, the shareholder, take money from the government. It's transfer. I, the shareholder, take money from the bondholder. It's a transfer. But the pot of money that could be paid to all the stakeholders doesn't change. All right? So the real enterprise value of the business is what we're going to care about. Second question, how do we then distribute the enterprise value? Where most people go right to that second question and think that that's an optimization. But that second optimization is a zero-sum game. Because as I said, there's just an amount of company, there's a pot of cash available to be distributed. Right? And we just have to start thinking about businesses in that context. Because from valuation, that's the more important question. The more important question is how much cash will this business generate to be distributed? Then we can figure out what it's worth and how to effectively distribute it. We got to have the question one answered. So we're going to separate the valuation into those two core components, and that's what the second theme of McKinsey's talking about in the book. Third, expectations matter. A company, or for that matter, any asset, is worth the sum of its future cash flows. That's modern corporate finance theory, born at the University of Chicago in the 1970s. We've been learning it ever since. So here's the key to all of that, is what the Chicago people proved is that basically over time, when they looked at historical data, that the cash flows companies generated over long periods of time, think more than 10 years with big data sets, equaled the price of the companies or the price of the assets, whatever asset class they looked at. And it makes intuitive sense because we should only pay for the actual cash that people generate. We shouldn't pay more or less for it. There's going to be opportunities for arbitrage. So you're worth the sum of your future cash flows. The longer you go out with bigger data sets, we see this is actually true historically. Is over 10 years with big data sets, you see a one-to-one correlation between cash generated and price of those assets. But here's the challenge. Companies are worth their future cash flows. Today, we have to guess what the cash flows are. So the real value of the company is not the cash flows, because we don't know what they are. It's our guesses of the cash flows. See, the mechanics of evaluation are actually pretty simple. It's an annuity followed by a growing perpetuity that's present valued. That's stock valuation, right? It's not that hard. The enterprise DCF process is just an annuity and a perpetuity put together, right? So here's the point. What we have to figure out is what goes into the assumptions, because I don't know what the cash flows are going to be. I have to guess, right? And so the data tells me that eventually, whatever the reality is going to replace the guesses. But the problem is that I'll never know what the future cash flows are because I'm living in the present. Even if I could jump into a time machine 10 years from today, the previous 10 years no longer matters the next 10 years. Asset prices of anything, including stocks, are always based on expected cash flows, are never based on historical cash flows. So therefore, the value of a company is the expectations. That, by the way, is why I'm asking you guys to do stock track. And that's why stock track is so critical, because stock track is the expectation game. In the short run, you're just playing an expectation game. In the long run, it's intrinsic value. But we always live in the short run. That's why it's so hard to beat the market, because it has nothing to do with what you actually earn, because if people expect you to earn it, then it's already priced in. So I'll talk about Warren Buffett in a minute, but basically what Warren Buffett makes his money on is mispriced stocks. Because unlike the academics that tell you the market's efficient, the market's not all that efficient in the short run. I'm just telling you, the Chinese manufacturing index came out on Monday, and the stock market plummeted further because manufacturing activity in China was worse than what people expected. How many people knew that? And for purpose of the video, nobody's raising their hand. How many know what the actual the index was supposed to be and what it came out at and what that means? How could we have a perfectly efficient market if you don't know that information? So that's the point. The market's semi-efficient, and there's some pros that are getting access to this information, and they can have more impact on the stock price. But in the short run, everybody can't know every piece of information. Now, eventually the day is going to come out, we're going to figure this out. But in the short run, we're living in that imperfect world. So what Warren Buffett realized a long time ago is the market's inefficient, and he can exploit that. He also realized that when a company is fairly valued, I don't want to own that. Because if I own a fairly valued company, well, there's no upside, because the expectations for the upside are already built in. So what he actually buys is what he calls out-of-favor companies. He finds good companies that are out of favor with the market. That's who he buys. And so he's playing an expectation game. So when you think about stock track over the next 90 days, you're not going to win stock track by figuring out what the long-term intrinsic value of the company is. And that's why I'm making you play stock track. How do you win stock track? If I were in your shoes and I just listened to what I just said, how do I win at stock track? Yeah.
Search for undervalued companies.
And how do I determine what's undervalued?
You could look at their, I guess you can look at their cash flow or PE if you want.
Well, I'll simplify what you're saying. You got to look at their expectations. And then you have to decide whether or not those expectations are realistic and how could they change. Because it's the change of expectations that matters, right? And this is where real world becomes a problem. Give me a company. Pick a company, any company. Somebody besides Apple. Everybody likes to talk about Apple. Who? Caterpillar? All right, so we'll talk about Cat. So here's Caterpillar. So as of today, and this is the point I wish to make, the analysts, 7 analysts say buy, 17 say hold, 3 say sell. In the real world today, there's not agreement on what's going to happen to Cat. This is how you make money. So the consensus is the average, but the average is not going to be right, and not even everybody agrees with the consensus. So you make money by exploiting that opportunity. Where is the market wrong about its consensus, and where do I think I'm going to make money? So here's the problem. You're really not going to make a lot of money on Cat. You're really not going to make a lot of money on Pfizer. You're not going to make a lot of money on IBM and Microsoft. Why not? because there's not that much volatility, because the expectations are probably a relatively narrow range, and the people that are doing this, it's relatively easy to predict a narrow range. So where do you really make the money? Yeah.
Tech companies.
Early stage tech companies, why?
Because they have such a huge potential for growth, and often at the beginning they're sort of, I guess you could say, undervalued sometimes because of high risk.
I wouldn't use the word undervalued. I'd say no idea how to really value them because there's so much uncertainty. So that's the point. But here's the idea, is you're still gambling. Because you're gambling that your information is better than what other people's information is. And that's what you're going to learn in Stock Track, is how to pay attention to that information and how to try and make some guesses. But if I'm trying to make money in 90 days, it has everything to do with what LinkedIn's going to report and what their growth rate is and how it matched against the expected growth rate. That's why if you're using Yahoo Finance, or if you have an Ameritrade or an E-Trade or a Fidelity account, you are so laughably behind the professionals, and that's why we're using Bloomberg, because if you don't know what the pros who are really determining most of the stock prices expectations really are, EEO, which is why we use this screen a lot in this class, for Cat, go back here, then you don't have a good baseline to start against. So that's the point. I could assume Cat's about to go through a big growth spurt, but if the market's already priced that in, then I might actually see Cat's stock price decline because they don't do as well as what was already priced in. And there's nothing to do with whether they do better or worse. Same thing, a company could report a loss, but it's less than what people thought they were going to lose, and so therefore their stock price goes up. Stock Track. Think about that as you're doing the Stock Track game. All right, next point. Competitive advantage. Over the long run, and this is in the reading, companies regress their ROIC, their performance and growth rates, towards a mean, specifically towards the cost of capital. All right, so first, to generate an above average return, you got to have some form of advantage. So that's the idea. Does a company have an advantage? Are they going to do better than their peers? So we've got to figure that out. And then number two, and this is the one that's often overlooked, competitive advantages don't last forever. So it's not just do you have an advantage, it's how long is that advantage going to last? And the news that you got to put in your mind is no advantage lasts forever. So if we talk about tech companies, the best performing tech companies today, Apple, Google, Samsung, until recently, others, Facebook, and what I'm telling you, go back a decade. Who were the best performing tech companies 10 years ago?
IBM.
Wasn't Apple.
IBM.
It was an IBM. It was Wintel, Microsoft, Intel, and to some degree a Dell computer maybe 15 years ago. Who was it before then? It was IBM in its glory days. They were big blue. You don't go wrong in buying from IBM. Now IBM's gotten out of the hardware business and they're just a software consulting firm. So the point is, competitive advantages erode. They don't last forever. And we need to understand that. So no matter how well Apple is doing today, I can guarantee you they're not going to be doing that well 10 to 20 years from now. And if we overestimate that, we will not have a correct valuation of a company. And it's the hardest thing for people to do because the market is almost like a horse with blinders. They are just focused on the next 2 years and they can't see beyond that. That's exploitable. Market has ADD, right? It should not be a surprise to anybody that at some point China is going to slow down its recession into recessionary times. How did we just wake up with this a week ago? I mean, seriously, nobody could have predicted that maybe the market was a little overvalued when the average PE on the Hong Kong and Shanghai Stock Exchange was 100, and the growth rates to support that long term had to be 8%, and the economy's not even growing at 8%. We woke up one day and we're like, oh shit, it's 7%, and it might be lower than that. Like, how could we not have thought, even law of large numbers, that was going to happen? And that's what I'm saying. This is what happens in the market. This is exploitable. This is something we need to understand. So we got to understand, when we look at companies, does a company have an advantage? And more importantly, how long is it going to last? So if you earn a great return, if you're growing really fast, nothing lasts forever. So that's got to be part of our analysis. Those are the four major themes we're going to cover. And related to that last theme is really the way Warren Buffett views the world. Sorry, a little mouse trouble here. So this, again, is something very important to kind of conceptually understand. Everybody's familiar with Warren Buffett, second or third richest man in the world, basically running a company called Berkshire Hathaway. Well, I want you to understand that the way he's made money, you got to understand a little bit of his history to understand this. So Warren Buffett, 50 years ago, or maybe 60 years ago at this time, started out as a Wharton undergrad. So in addition to having one of the better MBA programs in the world, Wharton actually has an undergraduate business program, which is also one of the best in the world, if not the best. So long story short, nothing against Smith, but in any event, Warren Buffett started out as a Wharton undergrad. And after his freshman year, he realized that his Ivy League education was not worth the price he was getting, and so he dropped out. And then he went to another school and he finished up his undergrad, somewhere in the Midwestern U.S. He went to Columbia, he got his MBA, and then he took over today what we would call a hedge fund, a company called Berkshire Hathaway, whose primarily ownership was owning a New England textile-based company. And what he quickly realized is there was no long-term future of a New England-based textile company. That stuff was moving to India and Asia, and that U.S. textiles were not going to be long-term competitive. So he treated the New England textile company as a cash cow, and he used the cash to buy into a business that he thought was the future. Does anybody know what that business was? His first two acquisitions? Sorry? It was insurance. He eventually bought Geico, but basically they were insurance businesses in Nebraska. Two insurance businesses, I don't even remember their names, but eventually insurance. But that was the point. And he sold the textile assets. So he saw insurance as the future business. He did not see textiles in the U.S. as the future business. The reason I say that is two things. One, when you think about how Warren Buffett is viewing the world, you got to think about how he runs an insurance company at heart, a hedge fund insurance company. That's their DNA. How does an insurance company make money? Well, there's two ways. Number one, premiums, right? I got to make sure I have good underwriting so that I pay out less in claims than I charge you in premiums. But here's the thing. If I sell life insurance to people in this room, you guys are 20, 21 years old, and hopefully you live into your 70s or 80s. Some of you are younger than that. So somebody's like, no, I'm not. I'm 19. But whatever. Many of you hopefully will live into your 70s or 80s. So I'm not going to have to pay those claims out for a very, very long time. So the primary way insurance companies make money is investment income. They take your premiums that you're paying them every 3 months, every month, every 12 months, whatever you pay your terms, and then they invest it in the market. And it's those investment returns which are their primary source of profits. What Warren Buffett realized decades ago is if he just hired some smart people from finance to basically put diversified portfolios in the market, he'd basically earn what every other insurance company did in the world. And the only way he was going to beat him was to do it differently. His definition of different, buying individual stocks. Berkshire Hathaway is just a vehicle to own individual investments that will outperform the market over a long period of time, and to generate the cash to eventually pay out the claims. That's the way he invests. So when he invests, these are the important rules. Now, he's got a few of them that we have to talk about very briefly, but number one is he doesn't invest in companies where he doesn't understand your business model. If it is opaque how you make money or how you're going to make money, he doesn't touch you. He doesn't want to own, LinkedIn, or he doesn't want to own Twitter, because even Twitter admitted they don't know how they're going to make money going forward. Well, why would I want to own you if you have no idea? There's just too much risk in that. So he avoids that if it's unclear how you're going to make money. Second, he buys dividend-paying stocks. Only dividend-paying stocks. Why?
Reduce the risk.
It's actually about risk. What's the definition of risk in finance? And I'll give you a hint. You can't see this on the video, but behind me I'm writing on a whiteboard. If you took a portfolio class, you plot expected return against what? Standard deviation. We define risk in finance as uncertainty. It's not whether you make or lose money. It's what's the potential outcome range, what's the distribution that could happen. The more volatility, the more standard deviation you have, the more risk you could take. Okay? So here's the point. Warren Buffett understands that. He's a smart finance guy. So he knows that the math people are all about the distributions. And the bigger the distribution, the more risk you're taking. Dividend-paying stocks reduce that distribution range. They reduce the possibility of standard deviation. Because a couple of things. And the tech companies are starting to push this right now, but generally you don't go public until you have an established business model. And Warren Buffett historically knew this. So I don't want to do startups. I want established companies. Number two, you pay cash flow. Think about bonds. A coupon-paying bond reduces the duration of a bond, just like a dividend-paying stock reduces the duration of an equity. So by getting the cash flow up front, First of all, I'm a more established company, reduces my range of possibility. And two, I'm getting cash flow all the time, which reduces the risk that I'm taking in that investment. Plus, I get investable income. So what I'm saying is Warren Buffett, it's not that he doesn't take risk, he just takes less risk. And then he looks for mispriced assets. And that's the other thing. He recognizes that the market is inefficient and the academics are wrong. Right? And this is on YouTube, right? Me saying this. And where the academics are wrong is we believe the market is completely efficient. And in the short run, it's just not true. I mean, if it were true, everybody would have known on Monday what was going to happen with the Chinese manufacturing index. And when it came out, we would have acted accordingly. We wouldn't have been surprised by it. If the market was truly efficient, you wouldn't have seen the VIX shut down because they couldn't price it last week because the market was open 1,000 and they couldn't handle that. So I'm just telling you, in the short run, the market's not as efficient as we think it is. Warren Buffett recognizes that. So what he thinks is, because we're playing an expectation game, he basically says that I'm going to think longer than the market. I'm going to have a point of view which I think is more right. And if I'm more right longer term, then I'm going to hold on to that point of view because I'm going to own companies for very long periods of time. And eventually the market's going to get that right. It's going to move in that direction. But I can't be a trader because if I'm just making money every 6 months in trading, there's just too much wild expectations in the short run. So I have to understand what's going to be the long run. So how do I do that? I start with good industries. What's the industry that's going to be good for the next 30 years? Because any idiot can make money in social media. And we see a lot of those companies now, right? Because that's the point. The market is so hot that I just need to be in that market. And I want to be in that market. And then I find the best companies that are going to do well in the market. What I don't do is I don't start with the good companies because if they're in a bad market, well, that's not the place to start. Now, they might be a company that happens to be in a good market, but I start with a good market. That's why we're going to do EIC. We got to differentiate where the good opportunities are and then what the companies are going to be able to earn. But the flip side is also true. We will look at what's the company, but we got to look at what its market conditions are because that's going to tell us a lot about the company going forward. All right? But he starts with the industry, moves to the company. And he does look at competitive advantage because he says, look, I'm a finance guy. I don't know how to run your business. And if I'm coming in here and I know how to run it better than you, then you're probably not that good to begin with. So he looks for very good, well-run companies. And he leaves them alone for the most part because that's who he wants to bet on. We bet on the people to be able to execute the businesses. That served him well, but he also doesn't bet on overpriced businesses. He says no far more than he says yes. Because here's the thing. If the business already has high expectations and the stock price is based on that, how am I going to make money? Right? It's already priced in. There's no upside if the upside's already there. So what he looks for is he looks for good businesses that are out of favor, where he knows they're going to be good businesses over the long run, and that's who he buys. He buys precision cast parts because nobody's thinking that precision cast parts is going to be a good company long term, and they're just not paying attention to that business, and it's out of favor right now. But he knows fundamentally, for whatever his point of view is, that that's going to be a good business long term, and that's the bet he's making. But he's got to be right. He's not always right. But generally, by doing the diligence, he's right more than he's wrong, and that's how he outperforms the market. He's not a trader. Now, what's interesting is that's not what I'm asking you to do in stock track. But the reality is we also have to make money in the short term. So you got to balance both. And I'm just saying, in the short run, it's an expectation game. And Warren Buffett also understands expectations because he doesn't want to overpay for stuff, and he wants to look for things that are undervalued. But in order to do that, I got to learn what the expectations actually are. And I got to learn how to trade that. So that's part of what we're going to be doing this semester. Now, continuing on. This is a very important concept. We're going to talk about some core concepts this semester. This is implicitly talked about in the book, but with a Joe twist. This is a real story. So I've worked with both companies, A and B, historically. Matter of fact, I was at B recently. And essentially, this story starts with company A. Right? So the company A story is this. They're publicly traded companies. They're competitors. They sell similar products. Right? Similar prices. They have identical margins. So two competitors, identical margins, identical growth rates, expected to continue, similar risks. Right? Publicly traded. CFO of company A basically says, the analysts agree with everything I just said. Right? And he asked me a question. His question was this. Why do the analysts have a buy on my competitor and a sell on me? Sell hold. It was a hold, but it really meant a sell. Why is my competitor's stock price going up and mine going down for the same earnings, same growth, same expectations for the future, and same cost of capital, right? And I basically asked him, I said, what's your cycle time? He said, what do you mean by cycle time? And this is the Joeism. The formula on the bottom of the page is Joe's formula for cycle time. What you do is you take invested capital, you divide it by annualized sales or revenue. That will tell you the percentage of a year that you're basically financing. So it's all invested capital, it's defined in the book. All the cash that you put in the business divided by sales is the percentage of the year that you're financing. Right? Multiply that by 365, translates into days. What the days tell you is on average, from the time you spend $1 of invested money to the time you collect $1 of cash revenue from a customer from a sale, how long on average does it take? Okay, so explain the concept. Company A got it. We got out the 10Ks and we did some math. His cycle time, based on his balance sheet and income statement, was 267 days in that formula. His competitors was 135. Business model, I give you $1, you make 8 cents every 267 days. I give your competitor $1, they make 8 cents every 135 days. Where do you think investors would rather go? Even the CFO of Company A reluctantly agreed, but then he said, but we have more upside. Okay, so this is a key because it's cash. B generates more cash because it's not a question of just how much, it's how often. Right? That's what cycle time is about. And what we focus so much time and attention on, and this is real world, is the how much. We're obsessed with how much. Margins. Got to get higher margins. But if it takes you forever to make the margin, and you got somebody else who makes a little bit of margin every day, I'll take the second one over the first one. Right? So again, it's a combination of the two. Right? That's what matters. So here's the point. These two companies had identical margins, but B is making it much faster. So I want you to think about this in a cash flow basis. I give $1 to both companies. They start working on their products in the same day. How much cash profit does A have on day 135? Given the data that's on the slide. Company A, day 135, cash profit. Yes?
4 cents.
No.
0.
Sorry to be direct. It's not 4 cents. The accountants would say 4 cents. That's the accounting bias. The accountants are accruing this. It's a piece of paper. It's not the actual cash. Because what's the definition of days? How long it takes to get what? What did I just say? To collect the cash from the customer. We haven't been paid yet. So regardless of what the accountant says, I don't have any money in my pocket. There's no cash. On day 135, what about company B? They have 8 cents. On day 267, now company A. Day 270, company B. 16. So that's the point. They make a second 8 cents in the same time it takes company A the first time to make the 8 cents. That's the competitive advantage, by the way. Right? So it's a combination of how much and how often. Now, what we do in finance, because we care about the cash flows, we annualize the data for comparative purposes. 8 cents every 267 days is 11 cents a year, approximately. 8 cents every 135 days is 22 cents of cash. I'd rather have 22 cents of cash per dollar invested than 11 cents of cash per dollar invested every day for the same risk. Would you everybody agree? That annualized number is ROIC. ROIC is the annualized margin and cycle time. It's the annualized how much and how often, and it translates into the actual cash flow that the business generates and therefore the value of the business. This is why McKinsey is a great company, because what they realize is nobody knows what free cash flow is because the accountants don't track it and the companies don't understand it. ROIC is intuitive. They're the same thing. So when they go to a company, they talk to you about your ROIC, not your free cash flow, but they know that if you generate more ROIC, you generate more free cash flow, and they work within the existing system. So they're an ROIC-based organization, but ROIC becomes free cash flow. So they are a free cash flow organization. They're just practical. Okay? Then JP Morgan walks in, they start talking about free cash flow, and the executives are like thinking about what their dinner's going to be and what Broadway show they're going to go to because they have no idea what the bankers at JP Morgan, they're like, yeah, just do your job. Okay? So back to this. Key points of understanding. I'm going to go a little bit more technical. I'm going to go a little bit faster because, again, this was in the book's reading. So, company, hypothetical company, define some terms. Makes $100 million of no plat or no pat. No plat is a McKinsey specific term. No pat is the generic term. They mean the same thing. Net operating profit after tax. This company, which makes $100 million of no plat, takes $50 million and reinvests, takes the other $50 million, pays out, call it a dividend. That creates two important ratios in finance. The reinvestment rate, the percentage of the profits reinvested, the payout rate, the percentage of the profits reinvested. Those two ratios have to add up to 100% of your profit. So what I want you to start thinking about is if a company makes a profit, they can do two things with it. They can put it back or they can pay it out. That's it. There's no middle ground. Right? They have two choices. If they put it back, it's reinvestment. If they pay it out, it's payout. Those two have to add up to 100% of the profits. So it's a question of what do they do with it. To keep it simple, I'm just going to say 50-50. Okay? Continuing on. I want to define two more terms. Growth and free cash flow. Start out with sustainable growth. I'm going to add a new assumption, 10% ROIC. This company made 10% in the past. It's expected to make 10% in the future. Keep the math simple. Right? I reinvested $50 million from the previous slide. I make 10%. I get $5 million of new profits next year. Right? My core business makes 10%, doesn't change. I get $100 million of core profits. I get $5 million on my new investment. I get $105 million next year. I'm growing 5%. My profits are growing 5%. Everybody see that? That's the mechanics of what's going on. Here's the shortcut. The shortcut for what we will call G, little g, also known as the sustainable growth rate, equals the investment rate times the ROIC. Investment rate is 50%. My return is 10. 10% of 50 says I can sustainably grow at 5%. It's a core formula you need to understand. So here's the point of sustainable growth. That is the rate at which I can organically grow my business. Right? To grow beyond this, I would either need to inorganically grow, do an acquisition, or I'd have to find external funding because I don't have the profits to fund that growth. Right? So I can grow faster than that, but I'm going to need external funds. Right? So the whole point of the sustainable growth rate is what can I grow internally with internal funds? How much am I reinvesting? What rate of return am I getting on it? That's what I can grow sustainably. Second concept, free cash flow. The value of a business is not its future profits. Say that again. The value of a business is not its future profits. And the reason why is because I have to take some of those profits and I got to reinvest it just to keep the wheels from falling off the car. Right? If I don't do any maintenance on my business, things are going to start to break. So at a minimum, I got to put some of the profits back in the business just to sustain what I have. Then, if I want to grow, I got to put even more money back in to grow. That's called reinvestment. So the point is, I can't pay out the profits because I'm using some of those profits to sustain and grow my business. What I can pay out is the profit after the investment. That is free cash flow. And that is the theoretical payout rate. And that is the future value of the business. Right? So what we're really going to focus our attention on is not what the profits are, but what the free cash flow is. Because that's the theoretical distribution. And back to the free cash flow. If this business generates $50 million worth of free cash flow, I can then choose what I want to do with the $50 million. Do I pay off the debt holders? Do I give a dividend? Do I buy back some stock? Do I put it into a savings account? Do I do an M&A? It is my discretionary cash choice. But this is what I mean by we got to be able to separate this out. I have $50 million of cash flow. What do I do with the $50 million of cash flow? All right? That's the way we need to think about the business. But the real enterprise value of this business is going to be that $50 million of free cash flow expected to go forward. Then, how do I distribute it? That's the way we're going to do valuation. That's enterprise DCF. That's Modigliani Miller. Right? But in order to do that, we got to figure out the free cash flow. Unfortunately, we don't get this from accounting. The accountants don't give us free cash flow. So we have to create it. right? This is why I told you that last week in September is the hardest and most difficult week of the class that you're going to hate. Because what we have to do is we have to take the accounting statements and we have to create free cash flow statements. And they don't exist. And we have to learn how to do it. And unfortunately, because there's not a GAAP standard for free cash flow, there's variations on how it's done. So I'm going to teach you how to do it formally, and then you'll realize that other people do it differently and take shortcuts. So that's what that week of class that I told you on Monday was going to be challenging, that's what it's going to be all about. And what free cash flow primarily represents is the cash coming from the income statement minus any cash reinvested in the balance sheet. That's what we get from the accountants, and that's how we create it. Now, as boring as this slide looks, this is another core concept for the semester. So continuing on with Company A. Company A is the company that was making $100 million, reinvesting 50% at 10% ROIC, sustainably growing at 5% a year. I'm going to add a competitor. We'll call it Company B. They have identical profits. They have identical growth rates. They have identical cost of capital expected to continue. 100 million, 105, 110. Given everything we just talked about, is A or B more valuable, or are they worth the same? So two companies with identical profits, identical growth rates, identical cost of capital. Yeah. And why is B more valuable? All right, everybody hear that? So he said B is more valuable because they have a higher free cash flow. And that's exactly the way I want you to think about it. Now, this is the point I want you to follow. Why does B have a higher free cash flow? So, I'll try this. We'll draw here, my pen. Start with investment. For the same profits, B does not have to invest as much as A to generate the same profits. Therefore, they generate more free cash flow. Reason, B is better at what they do. They make a 20% return on investment. A makes a 10% return on investment. This is the most direct way that I can show you that return on invested capital is directly related to free cash flow. If you generate more ROIC, you generate more free cash flow, and for the same risk, become more valuable. Caveat, at the same level of growth. All right? So if growth is the same and you make a higher ROIC, you generate more free cash flow. Because think about it intuitively. In this example, I don't have to spend as much to generate the same profits because I'm better at what I do. If I invest the same as you and I'm better at what I do, I will generate more profits for the same investment and generate more free cash flow. Either way, I'm going to have more free cash flow. I'm going to be the more valuable organization. This is a McKinsey insight. So that's the point. McKinsey realizes that when they talk to their clients, they don't know free cash flow, and free cash flow is hard. ROIC is intuitive. It's the same thing. It's easier to measure. It's easier to understand. When they forecast ROIC because it's a proxy for forecasting free cash flow. That's what we're going to learn how to do in the book, and that's what actually makes our forecasting much easier. Second part. This is where it gets more complicated. If the growth rates vary. So that's the point. If I'm lower growth but higher return, I get more cash flow growing slower. If I'm higher growth but lower return, I get less cash flow growing faster. Then it gets a little bit more complicated as to which organization over the long run is more valuable. All right? But all things being equal, ROIC is the proxy for free cash flow at the same level of growth. That's why we use it. Questions? That make sense? All right. So how do we then turn this into valuation? Bottom of this slide is something called the growing perpetuity equation. Long-term equity is just a growing perpetuity. Right? That's the formula that's used. Cash flow divided by R minus G. Well, this again is a key insight of McKinsey. The problem with the growing perpetuity equation, which is used all over the world, which is taught in the academic setting, is it assumes that the internal rate of return on future cash flows equals the internal rate of return on historical cash flows. Translation, whatever you do now, you do forever. So if I am doing really well and I use the formula, I'll overestimate the performance of the business because I told you the companies regress towards the mean over the long run. And that's why companies get overvalued all of the time. The flip side is, why does the Fidelity Contra Fund do so well? Because if I take an underperforming company, they'll never do better, and I'll undervalue them, and it's the time to buy them. That's Warren Buffett. So long as I actually think they're going to improve over time. They're not in some sort of death spiral and going away, right? But the point is, this is the limitation of the formula that is used in the real world that you've learned in business school that people use on Wall Street. So this was McKinsey's rearranging of it. They call it the key value driver formula. What they did is they took the growing perpetuity on the slide, and then they basically said, okay, free cash flow is profit times 1 minus reinvestment. We know sustainable growth is investment times return. Therefore, return is growth over return on investment. Investment rate equals growth over ROIC. So the formula on the right, called the key value drivers equation, is a growing perpetuity. Except by doing the substitutions, instead of forecasting free cash flow, I forecast profit and ROIC. Two practical advantages. One, it's a language that business owners actually understand and track. Two, this ROIC is incremental ROIC, which is different than historical ROIC/IRR. So the formula in the key value drivers allows us to have a different ROIC for future returns than historical returns. Now it's one for the whole future. It's not perfect, but at least it allows me to differentiate past and future. Okay, that's the improvement of this formula. So this is now leading into your homework 1 assignment for next week. You told me correctly that B is worth more than A. I want to actually use this formula to value A and B and actually see how this works. So I'm going to open up Excel and I'm going to create a worksheet. You zoom, I'll do 400%. Okay, so we have company A, we have company B. And there's 4 parts to that equation. Part 1 is my profit, also known as my NOPAT. 2 is my G. 3 is my ROIC. 4 is my WACC, also known as my cost of capital. Okay? That is going to give me my value. Now, looking at this slide, A and B, putting in the assumptions, both companies started with 100 million in year 1. Both companies had long-term growth rates of 5%. ROIC of A was 10, ROIC of B was 20, cost of capital of both companies was 10. So, using the key value driver equation equals NOPAT times 1 minus growth divided by ROIC divided by WACC as computer is frozen. It's kind of bad. Hello. Okay, let's see if Windows quit. No. First quit. Well, it's not dead, but we'll kill it anyways. Try this again. Open up Excel. View, zoom, 400%, A, B, NOPAT, no, NOPAT, G, ROIC, WACC, value, 100, 100, 5, 5, 10, 20, 10, 10. Formula equals NOPAT times 1 minus G divided by ROIC, right paren, divided by left paren, WACC minus G. There we go. $1 billion, $1.5 billion. Okay? What we intuitively thought, I'm just showing you mathematically what would be true. Now, in the real world, we have something called a multiple. Enterprise value multiple, price to earnings multiple. What's the multiple of earnings of company A? What are they trading at? What's their multiple? If that's their value. Price to equity, price to earnings. What's their price? What's the price of A? What's the earnings? They would trade it at a PE of 10. They would trade at a PE of 15. Multiples are just the shortcut for ROIC. That's the other thing I want you to start to understand. Is that there's a value of the company which doesn't change. So we just have different ways of valuing the company. And here's the metaphor I want you to understand. ROIC is the proxy for free cash flow. Multiples are the proxy for free cash flow valuation. They have to give you the same answer. So that's the point. It's just a shortcutting of the free cash flow. Now, generally, with multiples, what we do is we say, give me the earnings, take the multiple, take the earnings times the multiple, that's the price. But what we have to also get comfortable with is if we observe a price, we can work backwards to figure out what those cash flows had to be. So that's the point. I have cash flows, it creates a value, there's a multiple. I have a multiple, it had to be based on those cash flows. I should be able to figure out what those cash flows are and what assumptions had to be made to generate those cash flows. That is your homework 1 assignment. So we have to be able to work backwards from a multiple to figure out what those cash flows actually have to be. All right, we got to be comfortable working in both directions. So that's what the key value drivers equation can help us do, is it can give insight into why a company's trading at a multiple that it is. So let's be practical about this. And add a couple decimal places just so it's easy to see. What actually drives the value of a business? Well, it's these 4 things. Right? So if you really think about it, and I'll go back to the PowerPoint, skipped over this slide, but this is a graphical representation of the key value drivers. 3 things matter: spread, growth, competitive advantage, and sustainability. Right? So if I look at it, spread, growth, and what I think that these numbers are going to look at long term. That's what's key to understanding value of companies. Okay? So let's do a little simulation here. What happens to the value of company A and to the multiple of company A if it starts to grow faster? So company B says, you know what, we're happy in the US. A goes into Asia, and it's just got some better opportunities. Same margins, but they're just in faster growing markets. What happens to the value of A and what happens to the multiple of A? Because they can find sustainable growth. Same margins, but higher growth. It's going to increase. Everybody agree? All right, let's see how much. We can actually quantify that. Here's 6% growth. Here's 7% growth. Here's 8% growth. Here's 9% growth. Yep. Correct. It's not changing. I go a few more decimal places. It's not changing. So maybe our initial assumption might have been wrong. So let's go back. Did I screw up the math? All right. 6%, 7%, 8%, 9%. Yep.
Is it the difference between ROIC and WACC?
It is absolutely the difference between the ROIC and the WACC, which is what we're calling spread. What I have in company A is a zero spread, also known as a zero NPV business. I earn my cost of capital. When you grow zero NPV, you get zero NPV. My internal rate of return, proxy ROIC, is 10%. I'm borrowing at 10, I make 10, there's no value. I like to call this the treadmill. You run really fast, you don't go anywhere, eventually you get tired and you fall off. That's the challenge. Which leads to another point. Growth does not create value. This is a big misnomer that people have. because they're like, oh, we're going to create value, got to grow. And I'm not saying growth isn't important, but look, that there's no value being created in this growth because you're basically getting zero NPV projects that you do more of. Well, that's a lot of work to not go anywhere for a lot of risk. Why is B different? Yeah. I'm sorry?
There's a 10% gap.
Exactly. It's got the 10% gap between the I'm repeating it just for the video. They have the 10% gap for the ROIC. So therefore, it has a positive spread, and it's like exponential. So growth is gasoline on a fire. It's an accelerant. It's not value. It's the accelerant to value. And so what we eventually have to distinguish between is good growth and bad growth. Which companies are growing and are going to create a lot of value, and which companies are growing and are going to destroy a lot of value, and which companies are growing and nobody cares, right? It's not just growth, it's the companies we want to be looking for. And so therefore, it's the growth spread combination. And since most cost of capitals are similar, it's the growth return combination. Flip it around. What's a multiple? A multiple is an expression of three things: growth, return, cost of capital. That's a multiple. When you put the three together, that's why they're called the key value drivers. So when you see a company with a high multiple, a PE of 50 or 100, what it means is there's a lot of expectation for growth and return in the future that they haven't yet met. What's a PE of 10? It's a company that's not expected to grow that much, even if they have a decent rate of return, right? So we can start to interpolate some of this when we look at businesses. Now, another part of the simulation. I'll reset these. What happens if I double my profit at business A? They hit the lottery, same growth, same return, same business model, but they make absolute more cash for whatever reason. What happens to the value? What happens to the multiple? Yep.
Value doubles, multiple stays the same.
Exactly right. Same would be. So here's the way I want you to think about this. The way they originally taught you multiples in your finance class is they said take the earnings, grow your earnings, same multiple, company's more valuable. Same PE times more earnings equals more value. But here's why I say that's naive. Think the law of large numbers. As I get bigger, by definition, it's going to be harder to grow at the same percent. So these are dynamic. Okay? So that's the problem, is that when you get bigger and make more money, your multiple by definition is going to go down because you're not going to get the same growth rate because you're getting bigger. More dollars but less percentages. And growth is based on a percentage. So the problem is the multiple gets more dynamic. So that's the thing. I buy a company with a 50 PE, but then they make more money and their PE cuts to 25. Doesn't mean they're a worse company. It just means that they're bigger. Right? And so that's the thing, is that we have to separate that. And that's really hard for people to do. So back to this. What really drives the value? It's all four. What drives the multiple? It's these three. These are the things that drive multiples. So again, let me do a little simulation on multiples real quick. What happens if the growth rate increases? We talked about this, 6, 6. Higher growth, when positive spread, multiple increases. When zero spread, multiple doesn't change. Let me give you a third scenario. What if you're Coca-Cola and you say, you know what, the world is getting concerned about sugary drinks and diet sodas, so they're buying less of them. So we're not going to grow as fast as you thought we were. But we're going to kill $1 billion worth of expense. We're going to fire a bunch of marketers because we don't need a bunch of marketers if we're not selling more stuff. So we're going to maintain our margins. We're going to maintain our returns. We're just not going to grow as fast. Kind of sucks. We're going to look for growth, but we're at least going to promise you the returns. What happens to their stock price? What happens to their multiple? This is the expectation game. I priced you as if you were going to grow at 5%. I realized I was wrong. So I have to reprice you at a lower growth rate. Price goes down when the expectation goes down. This happens all the time. Scenario number 4. What happens when I have a negative spread? My return is less than my cost of capital. What happens to the value and the multiple when I grow? 6%, 7%. So assuming that this company in the short run can't fix the fact that it has poor performance, what would you advise them to do in their growth? Slow down the growth, right? So 7, 5, 3, 1, -2, -2, -0.02. And it starts to create value by avoiding those negative NPV projects. 4 decision points. You understand these 4 decision points, you pretty much understand the core concepts of this semester. And you understand stock track. So here's the way you should be reading any article that comes out and thinking about it in context of stock track. I read this article. There's 3 things that are going to determine the direction and the price of this company is going to go. One is what does the article tell me about their future growth? What does the article tell me about the potential of their future return? What does the article tell me about the future risks? As those change against the expectation, I can generally predict the direction of what's going to happen. And so that's what stock track, again, is about. Because when you're reading information, what are we realizing in China? They were scenario number 3. That the growth rate of China is below what people thought the growth rate was going to be, therefore the market is worth less. At a very high level, that's the mechanics that are what are happening, and we see it playing out right here in the key value drivers formula on a more simplistic basis. If you can intuitively understand that, you will go a long way on Wall Street, because in a way, that's what a trader has to do. Because if I'm a trader and I don't have time to do all the analytics, I got to have decision rules. What I'm telling you is the decision rules are related to these types of issues. So you're starting to intuitively learn directionality. May not know magnitude, but at least I'll know directionality. That's what you got to start thinking about when you think about your stock track teams. Does this make sense? Let me talk about homework 1. So, homework 1, which will also involve Bloomberg. View, Zoom. Hopefully, Bloomberg is still working because, like I said, Windows 10 on my laptop, I don't know, disaster on a Mac. All right. Here's the thing. I'm going to look at McDonald's as just a working example. You'll have a different company, actually 3 companies for your homework assignment. Now, I'm not going to tell you the exact companies you're going to have to do on the homework assignment because I have 2 more classes and I don't want people in those classes doing the homework instead of listening to me. Nothing against them, but they will. So therefore, I'm not going to post the homework assignment until 5 o'clock today. All right? But nonetheless, you will have to use Bloomberg in order to answer the questions, and you're about to see this. So, key value drivers. Free cash flow, ROIC, is the NOPLAT, which is the cash flow to the debt and the equity holders. Okay? That's the whole idea here. Return on equity, which is based on net income, is just the return to the shareholders. When I discount my free cash flow, I discount it at a whack because I need a discount rate for the debt and the equity. If I were to discount net income, I discount it just at the cost of the equity. Okay? So one method, dividend model that you probably talked about, is I value just the equity cash flows. The other method is I value the free cash flows. I can use the exact same formula, growing perpetuity, for both, but the inputs change slightly. Therefore, NOPAT becomes net income in a PE model. Growth is growth in net income. ROIC becomes ROE, and WACC becomes cost of equity. And instead of value, I get market cap. Just the value of the equity, not the enterprise value of the business. So I can use the exact same formula, but I can actually do a real world PE, where the first version is more towards enterprise value multiples. All right, something we'll talk about more. But here's the point. McDonald's. Companies are worth the sum of their future cash flows. Well, in order to get that, I got to go figure out what the future looks like. I'm hoping I'm still in Bloomberg. So what I'm going to do is I'm going to look up McDonald's. And I'm going to go to a couple of different screens. The first screen I'm going to go to is a screen, once I get to the company, called WACC. And this is a real-time WACC. And I want to look at what's called the cost of the equity. So cost of equity for McDonald's right now is 6.8%. As opposed to the WACC, debt and equity is 6%. Right? Because if I do the PE, I want the cost of equity. So 6.8%. The screen is the WACC after you get to the company. That's what you're going to have to do on your homework assignment. So, what was it again? 6.8. So I type in 6.8%. Next, I go to the EEO screen. This is the earnings estimate consensus overview. If your account defaults to quarterly data, you have to switch it to annual data. We need to be looking at annual, not quarterly data. Okay? So, companies are worth their future cash flows, which means I don't care about 2014, I care about the future. The pros, which you'll learn later in the book, look at the second forward year. That's when the numbers are more normalized, and that's the more important years for multiples. Translation, 2016. All right, forward year one is 2015. It's this year. But what really matters to the pros is what McDonald's is going to do in 2016. So it's the PE on 2016 expected earnings. Net income, and the pros use something called adjusted net income to take out accounting trickery, voodoos, and one-time items. Net adjusted income for 2016 for the company is $4,713,000,000. That's the expectation right now for McDonald's, for what their net income will be next year. That's the consensus, EEO. Next, the ROE. On this screen, over here, I can minimize, and it continues down. The analysts are actually forecasting ROE for the next 3 years. It was 33%. It's going to be 39, 55, 65. Those are the next 3 years. So here's what I'm going to do. I'm going to take equals, take an average of the three. So next year, ROE is expected to be 39, so I'll call it 0.39. The year after that, it's expected to be 55, so plus 0.55. Year after that, 0.65. Divided by 3. So somewhere around 53% is the expected return on equity average over the next 3 years. I want something that's representative of McDonald's going forward. I don't know if they're going to stay in the 60s, so I'm just going to say 3-year average is a starting point. Okay? Everyone with me so far? Now, back to this screen. Instead of minimizing, down here, Bloomberg is calculating, based on the current stock price of McDonald's, a forward PE. So in 2016, fiscal year 2016, the PE, price to adjusted earnings, right now is 18.61. Everybody see that? So the actual PE is 18.61. The model PE that we estimate, we got to figure this out. So here's the point. If I copy the same formulas over, our model would estimate a PE of 14.71, which basically says with no growth and those numbers, this would be our model estimate. Right? Everybody with me? So, is McDonald's expected to grow? Yes or no?
Yeah.
How do you know?
Because there's a difference between the model and the actual.
But why do we know that they're going to grow? There's one more assumption. It's obvious, but it's important to discern. McDonald's has a positive spread. If McDonald's had a negative spread, they might be expected to shrink their way to a better PE. Right? I know it's obvious, but McDonald's is expected to grow because they got a great return, and we're still not matching their current PE, so they must be able to grow to get to that PE. Does that make sense? All right, so back to this. This is going to be your homework. I'm going to give you 3 companies. You got to tell me what the 3 expected growth rates are based on the current stock price and why those companies are trading at higher or lower multiples based on the growth, the return, and the cost of capital. So you got to back into this. Now here's the thing. If you know 3 points from the model, you solve for point number 4. What you're solving for is the expected growth rate. So I just do a little bit of plugging. So let's put in, and I'll do this as a percent, 1%. Well, now I'm getting closer. What about 2%? So it's somewhere between 1 and 2. How about 1.5? How about 1.6? 1.55? 0.57? Oh, 1.57. I'm getting close. Somewhere around there. So basically, somewhere around 1.6% growth is what the market is using today for the long-term growth rate. That gets me a PE. By the way, what's the market cap of that? 87 billion and 595 million. If I go back to Bloomberg and I type in DES, which stands for description, that's where Bloomberg calculates a current market cap. I'm pretty close. Now, what I'm going to be missing is their cash, because McDonald's has some cash on hand. So it's the value of the earnings plus the cash on hand. If I had to guess, FA, and I looked at their balance sheet, McDonald's has about $2 billion in cash. I could have guessed that just based on doing the multiple. This is what I mean by when you start to know what to look for, you'll start to really understand what's going on. Because the real discussion of McDonald's stock price is this. What's the growth rate of Chipotle? Anybody know? Low double digits. What's the growth rate of Panera? What's the growth rate of Starbucks? What's the growth rate of McDonald's? What's McDonald's challenge? Is the challenge of McDonald's the margins they make on that store over there on University Avenue, Highway 1? What's the problem? It's growth. People are not going to McDonald's as much as they're going to these other places. That's why they're not as valuable as some of these other companies. But they're still making huge margins. It's not means they're not a valuable company. But to be honest with you, if you're talking about fixing McDonald's, what's the new CEO trying to do? Get people to go buy more stuff. He wants to grow because he knows that that's the value. And oh, by the way, this is beyond your assignment. Look what 3% growth does. That's a 30% jump in their stock price. If I get to 3% long-term growth versus 2% long-term growth. For them, growth is everything, right? So this is what I mean by the buy, sell, holds. Do I believe their strategy? Can they get more growth? Hey, buy. You know, if people are abandoning them because they sell beef, and beef is not as good as beef, right? So sell. Get the hell out, because they might actually not be buying because people are going to healthier lifestyles. They can't sell healthy food, not at the margins that they're making. So that's beyond this week. What you're going to have to do for your assignment, so this is for next Wednesday, because again, Monday's Labor Day, I'm extending it, is today I'm going to post 3 companies on your Bloomberg terminals while you're doing your Bloomberg certification. You'll have to go in, you'll have to create a spreadsheet that looks like this. You'll have to, using what's on here, just like I did for McDonald's, 3 columns, 3, figure out what the growth is based on the market values and the multiples. Now here's the thing. You're going to do it on different days, so you're not all going to come up with the same answer, and that's acceptable. Right? Because remember, this is real-time data. So if I did it today, and particularly in today's market, which is bobbing around, and somebody does it on Tuesday, McDonald's could have a different price and a different PE, and that's understandable. So the point is, I want you to put in the actual PE into your file so we, when we grade you, can see what the PE was at the time that you did it, right? As opposed to what it was that we thought when we put in the solution as a TA's grade list. Does that make sense? And then you'll upload your Excel file for McDonald's or whatever 3 companies I give you. It won't be in the fast food industry. Does that make sense? All right. Have a safe Labor Day weekend. I will see you a week from Monday for lecture. Enjoy Monday off. Next Wednesday, Bloomberg Lab to get certification. There will be a second homework assignment next Wednesday. Check on Canvas for that. See everybody in a week and a half. And this will be posted on YouTube sometime later today.